For the last 3 decades, Knowledge Center at Bursa has offered technology, resources, services, space, and a sense of community. Since 1985, 14,000 titles have been collected, with care and attention to high financial literacy standards. In collaboration with a global community of institutions, we ensure access to the world's diverse intellectual and cultural economic heritage, as well as fast online services for connectivity to the financial world. Serving the Bursa Malaysia community and beyond, Knowledge Center at Bursa empowers you in your trading and investment analysis research.
Financial information at my fingertips.
Visit Knowledge Center at Bursa Malaysia today for the collections, for the services, for the sense of community.
You have suffered financial loss while investing, and you think your bank, broker, fund management company, unit trust management company, PRS provider or distributor, or their agent or representative is responsible. You need help sorting out the problem or want to seek redress. Where do you go? Sidrek is here to help you start the conversation and reach some resolution. First, lodge a formal complaint with a company that sold or offered you the unit trusts, shares, derivatives, or other capital market product or service. But you're not happy with their response. You have 180 days from their final written reply to come to Sidrek. Or if there's no written response, and it's been 90 days since you wrote to them, you don't need to wait longer. You may come to Sidrek even though you haven't received a final response yet. Sidrek first checks the eligibility of your claim. For example, is it within Sidrek's claim limit? Is it against a member of Sidrek? And so forth. If your case is eligible, we begin the dispute resolution process. All information in this process is confidential. We get both you and the member you're complaining against to sit with us and have a conversation. Documents and information will be required from both parties. No lawyers are allowed in the mediation process, as we keep the discussions informal and private. Our mediators are impartial and will hear both sides out and help parties communicate constructively towards resolving the dispute. Two outcomes are possible at this stage. Either both you and the member agree to a settlement, or you don't. If the both of you agree to a settlement, an agreement is signed and the mediation process ends successfully. But if both you and the member fail to reach a satisfactory resolution, mediation has thus failed. But don't worry, Sidrek then proceeds to the next stage, adjudication. During adjudication, parties are given the chance to provide any further information to help their case and ask each other further questions. Our adjudicator will then study and consider all facts and information provided, including the conduct of the parties, laws, and best industry practices, as well as what's fair and reasonable. Sidrek's adjudicator will then make a final decision on the dispute and the monetary claim. If the decision is in your favor, it could be a full award or a partial award for your claim. But if the decision isn't in your favor, then no award will be made. You, the investor, will still have a choice. If you reject the decision, Sidrek will simply close the case and you may seek other legal avenues for redress. If you choose to accept the decision, however, the member has to comply with it. Once the parties have confirmed compliance to the decision, Sidrek will close the case. So let Sidrek help start the conversation towards resolution. For more information, visit sidrek.com.my or call 03 2282 2280.
Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, our webinar title is Income for Life Through Investing. So how many people here would love to have passive income stream, especially massive passive income streams for your life through investing, right? You may click raise the hand button. Thank you so much for raising your hands. Looks like we have the right crowd in the room where everybody will want to learn how do we build a consistent stream of passive income in our life through the stock portfolio. So that's exactly what we're going to do today. Now, disclaimer, whatever we're going to share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here in this webinar. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to introduce our speaker today. And Ms. Tang Wai-Ying began his career at RHB Investment Bank. She has spent over 9 years in the financial services industry while obtaining a dual license, which is specializing mainly in listed derivative and equities market. She regularly attends AGMs and company visits for different listed companies to keep her clients informed about the latest updates during her sharing sessions. And she graduated with a bachelor's degree in banking and finance from Sheffield Hallam University. So without further ado, let me hand over the session to Wai-Ying. How are you, Wai-Ying?
Oh, hi. Good evening, everyone. Let me share my screen.
All right, please.
Okay, can all of you see my...
Yes, perfect.
Okay. Okay. Hi, good evening, everyone. Thanks for joining me on today's session. My name is Wai-Ying here. And if during this session, you all have any question, you all can type in the chat box and my teammate will help to answer you all, okay? Okay, let me start the session of today. I'm excited for today because I get to share with you all some of the valuable lessons I have learned so far. Unfortunately, over my nearly 10 years in this industry, the market never goes up. I joined that time is this red color box over here. But during this period, I have had the privilege of gaining knowledge from a variety of sources, like from my client, from my colleagues, and also other industry professionals. Working with my clients in stock and future market is like a daily workout for my brain. I need to answer the questions from my clients for both the market and also from the sharing sessions I conducted. This had helped me to quickly accelerate my learning curve in investing and trading. The most significant insights I've gained is learning from other people's mistakes. At the same time, attending AGMs and corporate visits let me stay up to date with the company's latest operation plan, their financial performance, and also their future plan. This exposure also provides me the opportunity to network with other investors, analysts, and company representatives. After our company visits, we usually post write-up on our Facebook and Instagram pages and also did this WordPress page. If you are interested, please feel free to check out on our social media pages. And my teammate will post up the link. So if you're interested, you'll just click on the link and join our Facebook page, Insta page, or this WordPress page, okay? So let me start with the brief introduction on today's topic, which is income for life through investing. We are going to talk about stock market today. And when we hear the word stock market, many of us might think that it's a gambling or speculation. Let's put aside the boring financial jargon for a minute and think of it like as a game. It's like playing Monopoly, but with real money. Some people think it's like gambling or a lottery ticket where you are taking a chance on a stock and hoping for the best. But investing in the stock market can be a great way to generate passive income for life. Yes, you heard that right, for life. Think about it. Wouldn't it be amazing? If you could have a steady stream of income coming in every month or every year without having to work for it, that's what investing can do for you. It's like having a machine that generates passive income, allowing you to live your life on your own terms. Now, I know what you might be thinking. I don't know anything about stocks. Investing sounds great, but I don't know where to start. I don't have a lot of money to start this thing. I'm afraid of losing it all. Don't worry, okay? Don't worry. Today, we are going to guide you through the process of investing and invest in the stock market without being a financial guru. I want to share with you all, please don't have the misconception that investing just reserved for the rich people, for the wealthy. No, it's a very big no-no, okay? Even beginners like me and you can start small and gradually build our portfolio over time. In fact, there are plenty of inspiring stories of successful female investors who begin with normal 9-to-5 job. Let's take a closer look at these 4 successful female investors and see what we can learn from their journeys. The first one is Grace Groner. She is a secretary for a medical device company for 43 years. And during 1935, she purchased 3 shares of the company for $60 each and come up with a total investment of $180. And she held onto her 3 shares for the rest of her life, which is approximately 65 years, and reinvest all the dividend. And fast forward to today, 2010, that amount of investment of $180 had grown to more than 7 million, representing a compounded annual growth rate of 18%, which means every year able to earn 18%. And she left her 7 million estate to Lake Forest College to fund independent study. The second lady is this Sylvia Bloom. She is a legal secretary, worked in the same company for nearly 70 years, and quietly amassed a fortune of more than $9 million. In her will in 2016, she left 6.2 million to the Henry Street Settlement, a local social services group, along with another $2 million split in between Hunter College and a scholarship fund. The third lady is Gladys Holm. She is a sweet lady and like to wear red color vivid suit. And she want to make sure that every sick child in the hospital had a teddy bear on hand. Hence, her name in the hospital is called Lady Bear Lady. She worked as a secretary throughout her life, never making more than $15,000 a year before she retired in 1969. And she is able to make her fortune by investing in the stock market, starting with shares of her employer, American Hospital Supply. And having invested little by little, she left $18 million to the Children's Memorial Hospital in her will in 2002. This last successful investor is Anne Shaber. She is an auditor for the IRS company, but her story does not end with her retirement at age 51 in 1944 with $5,000. She focused on managing her portfolio for the next 51 years of her life, and she managed to accumulate a net worth of $22 million by the end of her life in 1995. She bought the company she knew and liked, and at the end, she donated her entire estate to Yeshiva University, and the university established the Anne Shaber Scholarship Fund in her honor. Okay, after successful women's story, let us come back to Malaysia's success story. Public Bank, the stock that made many millionaires. Consider one invested 72,000 in 100,000 shares of Public Bank at the start of year 2000, and the same investor need to spend an extra 10,600 ringgit to subscribe for the rights issue in 2014, and the total investment cost will be 82,600 ringgit. The value of the investment would have ballooned to 2.5 million by now, which means that the investor enjoy capital gain that amount to 2.4 million ringgit, which is nearly 300% return, not including dividend, based on the stock closing price as per Tuesday at 4.39 ringgit per share. Even engineers, they can also achieve financial freedom by investing in the companies they work for. These stories show that does not have to be the financial expert to achieve success in investing. Apart from investing in company that we understand or work for, these inspiring stories of ordinary secret millionaire share some commonalities. First, they recognize the power of investing in the stock market. Secondly, they had the patience to hold onto their investment for a long period of time, allowing compounding to work its magic. And lastly, these successful investors, they all demonstrated unwavering discipline and patience, even though they ride out the ups and downs of the stock market. These lessons show that every one of us can achieve financial success with the right mindset and right approach to investing. In fact, compounding interest may seem like a slow process, but over time, it can lead to significant growth in investment. Remember, even small steps taken consistently can lead to big results over time. So today, if you are a housewife, a retiree, or a student, or just someone who wants to secure your financial future and create a steady stream income for life, this webinar is just right for you. We will be discussing the strategies and techniques you can use to create your own investment portfolio that generate consistent income for your life. So let's say goodbye to loan repayment stress and hello to financial freedom. Now, why invest in stocks? While there are so many alternatives, why do we choose to invest in stocks? This is because not everyone wants to start a business, run a company, be in charge of a bunch of people, and that's okay. Some of us just love that what we do for a living. So, for those of us looking for a different way to grow our wealth, investing in stocks do give us the chance to own a piece of well-established company. It also gives us the opportunity to transform from just being a consumer to becoming an owner and potentially sharing in the success of some of the world-class company. Next, let us understand what is a stock market index. It's like a report card for the market or a specific sector, giving us a quick snapshot of how things are going. It makes it easier for us to track market or sector performance so that we don't have to keep an eye on every single company or counter. For example, the S&P 500 index made up of 500 of the largest company in the US. On the other hand, FBM KLCI index is the benchmark of Malaysia stock market, which represent the top 30 companies listed in Malaysia. So now, we go to the total return and we need to understand what causes the stock price to change in the long run. Let's begin with this investment return, which is this top here. Over here, can you all see my mouse? The first one, the first row over here. This chart shows that the average annual investment return on stock over the decades since 1900. We can see that the steady contribution of dividend yield to total return during each decade is always positive, averaging at 4.5%, which is the light gray color bar over here, the bottom one. So average is here 4.5%. The contributions of earnings growth to investment return, with the exception of the depression return during 1930 over here, this one, was positive in every decade, usually running between 4 to 7% and averaging at 5% per year, which is the dark gray bar over here. So add up will be 9.5% here. The change in valuation, on the other hand, have been highly variable, as shown by the fluctuation in the PE ratio over the years. You see suddenly here -3, then positive, then -6, then +9 like that. Despite the impact of speculative return on individual decades, in fact, there have been virtually no impact over the long run. The average annual total return on stocks of 9.6%, which is here, the last one, market return over here, has been almost entirely created by the enterprise, which is here, 9.5 over here, and only 0.1% created by speculation over here. The takeaway message of this chart is that in the long run, stock return depend on the investment return rather than the perception of investors, which count for little. By following the 80-20 rules, we can expect that the majority of our gains from stock, we can say that around 80% will come from investment return, which include earnings growth and dividend. The remaining 20% will come from changes in valuation. Now, let's move on to this. Stock market always crash. Compared to other investment classes, stocks are famous for their volatility. They can soar to a new high in the short term, but they can also take a nosedive just as quickly. And here's the thing. Stock market crashes, we got bear markets, corrections, and they are just part of the games. In fact, the stock market has seen 26 bear markets since 1928. It's the time when the stock market dropped 20% from its peak. And what about a correction? It's when the value of a stock has dropped at least 10%. And you know what? It happens 50% of the time. During a typical bear market, stock lose an average of 36% of their value, and it takes approximately 9.6 months or 289 days for the market to recover. In fact, over the last 5 years, there have been 3 bear markets. To be honest, stock market downturns, corrections, and panics can be painful and difficult to endure. And predicting the next bear market is impossible. So don't try to guess when the next bear market will come, okay? We will never know. But don't be discouraged. History shows us that even after major events like world wars and correction, market will eventually recover. The most amazing thing is that even though the market has experienced crashes, recessions, and corrections, stock has been classified as the best performing asset class and great way for individuals to build wealth over the long term. Here is a historical analysis of the S&P 500 return by decade from 1880 to present day. On average, the market has delivered a return of 180% per decade, while the average yearly return has been around 9%. With a long history of wealth creation, historical data has shown that stock has been outperformed other asset class over the past 200 years. By taking a 20-year rolling approach, even the worst 20 years, which is this square, this smaller one, even the worst 20-year period over here, still able to deliver a real return of 2.35% per year during 1960 to 1979. A real return means after factoring in the inflation. If without factoring in the inflation, the nominal return would be at 7.04% per annum. Whereas for the best 20 years over here, had a stunning return of 13.35% during 1980 to 1999. And with as little patience and the right strategy for compounding to work its magic, we could one day be living off the dividend from our portfolio. Now, come back to Malaysia market. Unfortunately, obtaining historical data on the Malaysia stock market is challenging, and I was only able to access data since 1970 from Credit Suisse latest investment return yearbook. After adjusting for inflation, the average annual return for the Malaysian stock market is 6.3%, which is here, here, 6.3%. Oh yeah, and who will ever think that Maybank market cap now is higher than Credit Suisse? Now, the economic behind long-term stock market growth due to various factors. First one, economic growth. A growing economy tends to translate to higher company profit, which can lead to higher stock prices over the long run. Whereas for inflation can reduce the value of money. It can also increase the price of goods and services, which can drive up corporate earnings. Interest rate. Lower interest rate can encourage borrowing and people to do investment, which can fuel economic growth and lead to higher corporate profits. Innovation and productivity like technological advancement and improvement in efficiency can increase productivity and profitability for companies, which can translate into higher stock prices over time. Growing population can lead to increased demand for goods and services, which can drive company revenue and profits and ultimately lead to higher share prices. The human desire to improve has pushed us forward as a species, leading to major innovation like the internet. The stock market reflects the collective effort of us and technologies that have the potential to change the world and make money for investors. Therefore, if we are investing for the long term, we are betting on the future being better than today, and assuming that the world over time will improve. Let's take a look at these individual stocks over here, Heineken Malaysia. I'm sure that most of you are familiar and understand the product produced by this company. 15 years ago, the stock was trading at around 5 to 6 ringgit over here. Here, which is around here. And at that time, the dividend per share is roughly 33 cents. If you had bought the share at 5 ringgit, your dividend yield would have been 6.6%. Fast forward to today, our dividend per share has increased to 1 ringgit and 38 cents, resulting in a dividend yield of nearly 28% on your initial investment. Furthermore, the share price has appreciated significantly to 28 ringgit now, from 5 ringgit to 28 ringgit, purely on the appreciation of share price. Amazing, right? Well, that's the beauty of investing in stock. Now, we will talk about this guy, Richard. I'm sure that most of you heard of the Asian financial crisis in 1997, right? It had a significant impact on our Malaysia market, resulting in a sharp drop of nearly 90%. And that is the time where many shares that traded a few hundred ringgit that time become a few cents in the aftermath. Now, let's say our friend Richard, a very, very unlucky guy. He invested his money right at the peak before the crisis, and let's see what will happen to his portfolio after 20 years. Yes, he has a capital of 75,000 equally invested into these three companies, and he buy at here the peak right before the crisis, which is here the red color box here. And for Public Bank, which is over here, and Heineken over here, Petronas Dagangan over here. Ta-da! This is the result. In this scenario, the dividends are not reinvested. The portfolio grew from 75,000, here the last one, to 1.25 million, representing a compounded annual growth rate of 15%. The final value will certainly be higher if Richard reinvests the dividend. Does this mean that if we simply pick a stock, the answer is definitely no. Well, let's see Proton, this example, and Mars, which were already delisted. Both these counters generate a negative return during the same period. So, picking the right business is one of the key factors in successful investing. Despite the Malaysian market has performed poorly after I joined the industry, the red color box here is the time when I joined and then never go out, okay? But some of our clients were able to achieve significant gains by investing in company with strong fundamental, like this few company. This solidified my belief in the importance of investing in high quality businesses. Over the years, we have found that this strategy has effectively helped many of our clients compound their wealth. We always follow 3 key rules. Focus on high quality business. Focus on high quality business, invest regularly, and build a diversified portfolio. For focus on high quality business, according to Mr. Buffett, the ideal business is one that makes a lot of money compared to the amount of money it invested and continue to use a lot of money to make more money. That becomes a compounding machine. Having cash available to invest, especially during market bad time, means we are able to add new stocks to our portfolio without first needing to sell other stocks on hand. If you can invest regularly, just like how you consistently spend on any shopping platform, why not you spend on this? If you spend 100 ringgit for 2 times in a month on any shopping platform, you are making 0% effort on investing. But if you use the 200 ringgit of every month to buy the business you like, it would become 2% investment effort for the month. Even small amounts each time is the consistent that matters. Each small amount compound over time, resulting in significant long-term gain. So, let's put your trading app under your phone shopping folder so that every time when you want to buy things from the shopping platform, you can choose to click into your share trading platform, use the money to buy the business you like. Well, to build a diversified portfolio is not by holding 20 stocks in the same industry. This is not diversification. For example, 2021 was a very bad year for glove stocks. I believe a lot of people hold most of the glove company on hand, while 2022 for tech stock and this year, banking stocks. In order to avoid this happen to our client, we advise our client to invest in stocks from at least 3 to 5 different industries. Apart from the 3 key rules we mentioned, high quality business is important as well. The most important measure of a good business in financial terms is it makes a high return on capital. In other words, profits in cash divided by the capital needed to run the business is in high number. Okay, maybe it is too difficult to understand from this lengthy sentence. Now, let's say I'm going to start a business and the capital needed is 1 million ringgit and I'm asking you to invest in my business and I'm telling you that this business expected to make 40,000 ringgit every year. That would be 4% return on capital a year. Is this considered a high number? Would you be interested? I suppose you would rather put those funds in FD, right? Because FD is safer ma. Secondly, we need to know not just whether a company can make a high return on capital, but can it reinvest those cash every year at high rates of return? There is no point for the company to have a very high capital in the business that is not growing, and we can't deploy the cash into growing the business. Lastly, a business needs to have a strong competitive advantage to prevent mean reversion. If a business has a very high return on capital and good reinvestment opportunity, there will be competition. There is a term called mean reversion, which means that all return revert to the mean in the end of the day. It also means that if a company has a very high margin or high return on capital, it will attract competition. People will start to enter the industry, and slowly, the return will be driven down to the average level. And if a company has a very poor return on capital and margin, capital will exceed that market or go bust. And slowly, the return for a company within that industry will start to gravitate up toward the mean. However, there is still a small group of companies in the world that don't mean revert. They have superior margins and returns that don't get competed away. And that's because they have a strong competitive advantages like brand names, patents, intellectual property, and as a result, they were able to fend off competition. And those are the companies we seek to own. We are done with the concept of theories. Let's move on to the numbering now. Before we dive in these boring figures, I want to remind you that you don't need to stress about the calculation. With the help of the internet, most of the numbers will be readily available to you for free. Today, you just need to focus on understanding the concept. Now, let's consider of running a luxury handbag business. Assuming one bag we can sell 400,000 and we can sell 10 bags a year, and our revenue will be at 4 million ringgit per year. However, we must consider the cost of producing the handbag, which includes raw material like alligators and hiring bag makers. This is considered as cost of sales, which will cost us 1.2 million ringgit. In addition, we may need to activity, which would be considered as operating expenses. And of course, we cannot, take out a 1.2 million. And at the same time, running business have to pay tax, and we cannot forget about taxes, this thing. And let's say we pay a 400,000, and this profit will come to a net, this business will come to a net profit of 1.2 million ringgit. Generally, this is usually how a business makes money or profit. Now, if we want to increase profit on our bag business, we need to focus on improving our sales, right? Let's brainstorm some idea to boost revenue for our bag business. Does anyone have any suggestions? You all can put your suggestion on the chat box. Any suggestion to boost revenue for our bag business? Anyone? Okay. Marketing from Mim. Mim. Anyone else? Okay. So we can lower the cost from Bernard Ralphie. Yeah, correct. So we can actually improve our sales by selling more bags or increase the selling price for our bags. If it proves difficult to improve revenue, we may need to explore other alternatives, such as cost cutting, reduce our marketing budget, closing down loss-making store, or even make the hardest decision, which is to fire some employees. And the problem is, we can't keep cutting costs forever to improve our business earnings. Another option is that we can acquire another business to grow our revenue and profit. But this approach can be costly because we may have the risk of overpaying for the acquisition. Now, we know our business currently has a profit, but we need to understand another term, which is free cash flow. We may have a profit from our business, but that doesn't mean we have received cash. Thanks to the accrual accounting concept, which records revenue and expenses when they are earned or incurred, regardless of when the cash is received or paid. This means that revenue and expenses can be recognized even if cash hasn't been exchanged yet. This makes free cash flow an important indicator. Now, let's assume that we need 6 million to start the bag business and the profit per year is at 1.2 million. The return on asset and return on equity will be at 20%. Why both the ratio is the same? Because the company got no debt, no liability, and if we were going to liquidate the company, the total asset value will be equivalent to the shareholders' equity. Now, if I only have 4 million, I need to borrow money from my mom, 2 million. And my ROE will now be at 30%. If my mother is richer, she's willing to lend me 3 million, and my ROE now will be at 40%. In this scenario, we can see how leverage affects a company's ROE. Now, assuming that the FD rate is 4% a year, we would want our business to earn at least a few percentage points higher than 4% to compensate for our risk. Because invest in business, the risk will definitely be higher than we put our money in the FD. In this case, preferably at least twice the rate. Let's take a look at Singapore Airlines over here. It's been known that the airline is a very competitive industry. And before COVID, which is 2020 over here, 2020 over here, the Singapore Airline ROE has been below 7%. The same goes for the whole industry, the blue color line over here. The return on capital has been below 8% for the past 20-year periods, which makes the stock in the industry more suitable for trading, but not for long-term investing. Next, after we make a profit from our bag business, we need to understand what is payout ratio. When a company earns a profit, it can either distribute the profit to shareholders as dividend or reinvest them back into the business for growth and expansion. In scenario 1, assuming the company does not pay any dividend and is able to maintain its ROE at 20%, it means that the company can grow its profit at 20% a year. If the company payout ratio is 100%, assuming all else remains equal, the growth rate will be 0%. However, with a dividend payout of 50% and reinvest back the 50% of the profit into the business, the growth rate would be at 10%. Therefore, if we have a business with a very high return on capital, logically, we would want to reinvest all our profit into the business for growth. However, not every business has the same reinvestment opportunity as they start to grow bigger, then distribute some or all of the earnings back to the shareholders would be a more sensible choice. Okay, back to our business. Just now we have a net profit of 1.2 million from the business and number of shares outstanding of 120,000. The earnings per share would be at 10 now. If the dividend payout is 300,000, the dividend per share would be at 2 ringgit 50 cents each. And by dividing 300,000 over 1.2 million, payout ratio would be at 25%. Okay, so far so good. Okay, now imagine that you are a shareholder in our bag business, and this cute fella come every day. His name is Mr. Market. Now, the thing about Mr. Market is that he is a very moody guy, and his emotion often driven by short-term news or event. For example, if today he wake up with a positive news about the company, he might be very happy, excited, and offer to buy your shares at a high price. But then, if there is a negative news today, he might be very sad, very emo, and offer to sell you his shares at a low price. As a shareholder, you have to decide whether to take Mr. Market up on his offers or not. If you believe that the company's long-term prospects are good, you might choose to hold onto your shares and ignore Mr. Market's emotional outbursts. On the other hand, if you are feeling uncertain about the company's future, you might choose to sell your shares when Mr. Market is offering a high price. The key takeaway from Mr. Market concept is that stock prices can be driven by short-term emotions and news, rather than the long-term fundamentals of the company. As a shareholder, it's important to stay focused on the big picture and try not to caught up in Mr. Market's daily mood swing. At the same time, valuation is the key for us to understand, to determine whether the price is expensive or cheap. Now, we need to move on to the valuation part. Let's take a look at our bag business. If we buy this business for 100 ringgit and the earning per share is 10 ringgit, we would be making a 10% earning yield every year, assuming the earnings per share remain the same. The formula for earning yield is 10 divided 100. We can look at this from another perspective. It would take us 10 years to take back our money if we buy this business at 100 ringgit. The formula for PE ratio is we take 100 divide 10. If the business we invest in offer a dividend yield of 2.5%, the formula for dividend yield is 2 ringgit 50 cents divide 100. Now, let's say if we are willing to pay for a higher price for our business, let's say 200 ringgit, your earnings yield would fall to 5%. And if let's say you really can buy at 500 ringgit for this business, your earnings yield will only be at 2% now. Okay? So now we have gone through the basic. Let's do a test. Let's say you are going to make a decision on investing in a company for your investment career. It's going to be a 40 years long. You can either invest in company A or company B. Company A makes 20% return on capital and company B make 10% return on capital. Assuming both of them retain 100% of their profit and reinvest back into the business at the same rate of return. Now, can I have the idea of anyone want to own company A or anyone want to own company B? You all can leave your answer at the chat box over there. Anyone? Wow, okay. Most of the people pick A. Okay, now, in this scenario, I might not giving you enough information to answer this question. We need to know that what value we buy and sell it. Now, here's what happening with these two companies. Company A is priced at 20 times PE, while company is only priced at 10 times PE when you buy it. Now, with this additional piece of information, anyone want to change your mind now? Company A or B? B? Okay, most of the people choose B now. Okay, how about when you sell them after 40 years? It's all gone horribly wrong. You bought company A at 20 times PE, the valuation dropped 50% to 10 times PE. How about you sell them after 40 years? It's all gone horribly wrong, okay? You bought company A at 20 times PE, the valuation dropped 50% to 10 times PE. That's really a very bad luck, isn't it? On the other hand, company B has done really well. It has gone from 10 times PE to 20 times PE. The valuation doubled. And here's the answer. Company A with a 20% return on capital, which you bought at 20 times PE, sold at 10 times PE, would give you a share price return of 18% per annum, which means that every 1 ringgit you invested turned into 735 ringgit. Whereas for company B, with a 10% return on capital, even if you double the valuation, you will only get a 12% annual return and end up with 91 ringgit with every 1 ringgit you invested. Okay, now, why is return on capital important? According to Charlie Munger, Warren Buffett right-hand man, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you are not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you will end up with one hell of a result. And according to Warren Buffett, over time, it is hard for investors to earn returns that are much higher than the underlying business return on invested capital. So, I hope that by now you understand the importance of return on capital. Okay, now we will move on to the pros and cons of investing in a company with a good dividend yield. The advantage of invest in high dividend yield company because company that consistent pay dividend are normally well-established company with strong financial. They are likely to provide us with a steady income from consistent dividend. As investors, we get to pay to wait for good things to happen in the long run. On top of that, their stock prices tends to be less volatile. If we buy a stock with a dividend yield of 8%, and if the company is able to sustain its dividend payout, we will most likely receive a predictable return of 8% a year from dividend. Sometimes it's better to stick with what we have. In this scenario, the dividend received, then risk it for something greater, which is on the future earnings growth. On the flip side, if a company distributes most of its earnings as dividend, it will have less fund to reinvest into the business. This has limiting the company's growth potential. Besides, have you heard of the saying, good things not cheap, cheap things not good? Sometimes stocks are cheap for a reason. In Malaysia, most of the high-yield stocks are concentrated in REITs, utilities, telecommunication, and consumers sector. Some company will look for other alternatives like borrowing more money before cutting dividends. And the dividend reinvestment plan will cause earnings dilution. Now, let's go to some proof data on high dividend yield investment. Research has shown that dividend growers and initiators have outperformed the broader market and stocks that do not pay dividend. Dividend grower and initiator over here, the top one, and this is the broader market, and this is the company that do not pay dividend. So you see it outperformed the market. This index shows that companies that have increased their dividend in each of the past 25 consecutive years can perform better. Since there are not many studies on Malaysia high yield stock, we can take a look at the MSCI ASEAN High Dividend Yield Index. And the results show that this index has outperformed the MSCI ASEAN by 4.66% a year since its inception in 1998. In general, if done right, dividend investing is a viable strategy in the long run. Now, can we simply invest in the stock with high dividend yield? I'm sure by now you know the answer is no, definitely no. Let's have a look on this example. Notice these two little gaps in this chart over here, the red color one. These are usually what happens after a company distributes dividend. There will be adjustment in the stock price. Let's take a look at this research report from 2017 with a list of high dividend yield stock. If we had simply invested in the top 8 companies with the highest dividend yield in the list, we would not be very happy now, I'm sure. Let's take a look on the top 8 company performance. You see that time 2017 is over here, the red color arrow here. The result is so-so. The next one, you buy here, the red color arrow over here. Moreover, we would be even more emotional if we found out that some low yield stocks with high return on capital perform tremendously well during this period. You see, during the same period, these few shares can perform well. In conclusion, if we solely concentrate on stocks with high dividend yield and ignore other factors, we may overlook some better alternatives, as dividend is a reflection of a company's capital allocation strategy. It doesn't paint the whole picture. Sometimes superior performance comes not from what we buy, but from what we exclude. Next, now we need to understand the difference between borrowing money and paying dividend versus borrowing money to pay dividend. These two look same, but they are different in the intention and purpose of borrowing. Borrowing money and paying dividend means that a company is generating enough cash flow from their business to pay dividend to shareholders, but it may choose to borrow additional funds to invest in growth opportunity. On the other hand, borrowing money to pay dividend means that the company is using borrowed funds specifically to pay dividend rather than relying on its cash flow. This can be seen as a red flag. Let's examine Heineken Financial and see how they compare. Over the past decade, their free cash flow to net income ratio was close to 100%, indicating a healthy cash flow position. This is certainly an encouraging sign for investors to take note of. Now, let's take a look at this case study. At a glance, it has a strong return on capital, is growing and are expected to grow at a double digit, which is the red color line over here, double digit growth, and the valuation is cheap. is paying dividend that's better than FD paying dividend over here, the 3.4%, 4%, 4.7% over here. Everything looks good. You see, this research report also show double-digit growth, got dividend, double-digit growth, got dividend. On top of that, all research analysts have a buy call on these stocks. You see, everyone buy. Different date also buy. Here, remain buy. Now, enter one of the most important indicator, the free cash flow that we had mentioned just now. Despite having negative free cash flow over the past 4 years, the company continued to pay dividend to shareholders while its debt level increased. Side note, even a company like Apple did not pay any dividend between 1995 and 2012, even as it has over $50 billion in cash in 2011. Apple started to pay dividend in 2012 as a way to distribute its growing cash reserve to its shareholder. Okay, now let's back to this company, that is stock price, and raise concern among investors. The issue began when the external auditor, KPMG, raised their concern about some of the transactions that were identified during its routine audit. KPMG highlighted potential discrepancies in the company's revenue recognition. The company initially denied any wrongdoing and claimed that the discrepancy were due to difference in accounting standard used in different countries. However, the company later announced that it had identified accounting irregularities and was taking steps to address the issue. Following the announcement, the stock price fell sharply and the company management team also resigned, leading to further concern about the company's governance and transparency. Your sendiri guess, I cannot review. Well, the rest is history, okay? Now, Transmile is another classic example. Despite everything looking good, the company had negative free cash flow every year. While it's normal for a company to have negative free cash flow in some years as they expand their business, consistent negative free cash flow coupled with dividend payment may raise a red flag. At this point, I hope you understand the significance of focusing on high return on capital, which involves the cash flow. Okay, done with the case study. Let's move on to the next slide, circular trend. We look for companies with source of circular growth instead of cyclical growth, the ones that goes up and goes down. While every trend has a bit of cyclicality in the short run, this growing industry often show a long-term upward trend, driven by factors such as technological innovation, changing demographic, and a global shift in consumer behavior. Therefore, it offers significant growth potential for the company operating within them. This one. As the population continues to grow in Malaysia, it has greatly benefited the company that operate in the consumer product and services space. As people income starting to increase, we can see that the average trading value for the Malaysia stock has been growing as well. Interestingly, Bursa tends to perform well during the period over high market activity, such as in 2007 and 2020, the two arrow over here. But then, after the boom, the share price is like, so do we need to be careful when Bursa is making huge money? Okay, now have a look on this. As more and more chips are needed in smartphone and cars industry, despite some short-term cyclicality, the semicon industry has been in a long-term upward trend for many years. This has greatly benefited the tech company in Malaysia as well. Now, let me share with you how we usually screen stocks and create our watch list. There are 13 sectors in Malaysia. Our approach to screening for stocks in Malaysia involves identifying companies' revenue and profit growth, company with high return on capital and free cash flow. At the same time, acceptable leverage over several years. We then compile a watch list of such companies. We often observe clusters of companies within certain sector. You can see like this consumer sector, which is the first one, have the longest company list that fulfill our criteria. This suggests that the industry as a whole is growing, which in turn creates opportunities for the individual company operating within this sector to grow. We then focus our attention on identifying the strongest companies within these growing sectors. But then, if you don't wish to go through every company listed in Malaysia, which is like more than 1,000, it's a good idea to start with stocks with the highest market cap and look for businesses you understand. From my experience, you will be able to find a number of good companies by just going through the top 100 or 200 companies in Malaysia. Now, we are at the competitive advantages. In the stock market, long-term stock price growth is driven by future profit, but not all businesses can sustain growth indefinitely. One major reason is that high profit or prospect of high return attract competition, making it challenging for companies to maintain their profitability in the face of new entrants. However, a small number of companies have been able to achieve sustainable high return on investment by creating a durable competitive advantage, or we can say it as economic moat, that allows them to fend off competition and maintain market share. The term economic moat, popularized by legendary investor Warren Buffett, refers to a business ability to protect its long-term profit and market share from competitor through branding like LVMH here, creating high switching costs for consumer customers, which is Microsoft over here, driving down the cost like Walmart over here, and other factors. Now, after we screen for the business we want, then how do we determine what is the right price for these businesses? We compare the earnings yield of a company with a risk-free rate. In this scenario, we are using the 10-year high payout ratio that can increase its revenue. Example, Heineken, earnings yield slightly above the 10-year bond yield will make it attractive, will remain the same for the next 10 years. On the other hand, good company like Heineken may be able to increase their earnings at a decent rate. Hence, the dividend we receive down the road may be higher than what we see today. In order to provide a greater margin of safety, we may consider adding an additional 1% above the 10-year yield. This would help to account for any potential risks or uncertainties associated within the company, as well as provide a buffer for any unexpected event that may affect its earnings or cash flow in the future. If, for example, the 10-year bond yield is 4%, we would look for a company with earning yield of 5%, which translate to a PE ratio of 20 times. How do we get the 20 times? We use 1 divided by 5, then we will got the PE ratio of 20 times, which represent the highest valuation we are willing to pay for a company. Now, let's have a look on this counter. Wait, I share you a case study. Let me shift my share screen over here. Okay, can you all see it's a Bursa Marketplace page now? Okay, so now we come here and we click search and we go to Heineken Malaysia. Heineken Malaysia. Okay. Now, we can see that from here, the earnings per share for Heineken is RM1.36, which is around RM1.37. And we go to this analyst consensus over here. Then scroll down a bit, and we can see here, analysts expected that the earnings per share for Heineken Malaysia is around RM1.44 by the end of 2023. And by the end of 2025, it will be at around RM1.59. This represents an expected annual growth of more than 4%, which is a pretty normal rate for a mature consumer company. And I hope you guys still remember what is earnings yield. And since the current Malaysia 10-year government bond yield is around 4%, with an additional 1% margin of safety we mentioned, our required earnings yield for Heineken Malaysia would be around 5%. Now, we can calculate the maximum price we are willing to pay for Heineken by dividing RM1.44 over here by 5%. That gave us a maximum price of RM28.80. It means that as long as Heineken Malaysia is trading below RM28.80 and there are no significant changes in interest rate or the business fundamental, we consider the valuation at reasonable range. There's a disclaimer, this is just the example of the case study, not a buy or sell recommendation. Okay, now I will come back to here. Okay. However, for company with strong track record of high return on capital and the ability to reinvest cash for growth, we may be willing to pay a premium of up to 2 times the original PE ratio. In this case, 40 times earning, up to 40 times earning. Now, I will use this company as case study. I will share you all again the screen. Okay, now back to here, and then we search Wittrox. And using, this is a Wittrox company, and using our criteria of accepting a PE ratio up to 2 times the original PE for the stocks with high growth potential we mentioned just now, we can determine the maximum price we are willing to pay for Wittrox based on its earnings per share. Now, earnings per share for Wittrox at trailing rate is around 0.194. And then we go up to this analyst consensus again. And here, analysts forecast that by the end of 2023, earnings per share will be at 22 cents. By the end of 2025, its earnings per share is projected to reach 33 cents, which is a 70% growth from today's earnings per share and expected to grow at an annual growth rate of 20%, nearly 20%, showing that Wittrox is a growth stock. assuming a 5% earnings yield return we mentioned just now, we can calculate the maximum price we are willing to pay for Wittrox by dividing its projected earnings per share. We will be using 22 cents divided by the annual return, earnings yield return 5%, and multiply it by 2 because we can accept 2 times maximum the PE ratio. So it will give us the maximum price of Wittrox, which is at around 8 ringgit and 80 cents. As Wittrox is currently trading at around 7 ringgit and 88 cents, it is within the acceptable range and the valuation is considered reasonable. And then, this is just a case study for you, not a buy-sell recommendation. Okay, now back to here. Okay. Okay, now back to the slides. The chart shows that PE ratio that could have been paid for certain stocks in 1973 in relation to achieving a 7% compounded annual growth rate over the next 46 years until year 2019, compared to the 6.2% compounded annual growth rate of MSCI World Index return over the same period. And then don't forget, most important is the 10-year treasury yield at that time was around 6.5%, which with the addition of 1% margin of safety and the doubling of the PE ratio would result in an acceptable PE ratio of 27 times. We take this here, 6.5% plus 1% margin of safety total to 7.5%. And we use 1 divide by 7.5, multiply by 2, and you will get the PE ratio of 27 times. The chart shows that even with high PE ratio, such as paying 288 times for L'Oreal, 126 times for Colgate, 100 times for Pepsi, 63 times for Cola, investors could still have beaten the market. However, we are not suggesting blindly paying high multiples for any company. Rather, this information puts the misconception that high PE ratio equal expensive stocks into perspective. Now, let's take a look at Coca-Cola PE in 1972. Before the 1973 oil crisis, it was trading at around 46%, which is here. And when the market hit the bottom in 1974, by 1973, investors lost interest in the stock market. And then when the market hit the bottom in 1974, Coca-Cola was down by 70%, which gave investors an opportunity to invest in Coca-Cola for less than 13 times PE. The earnings per share growth for Coca-Cola for the next 25 years was around 13.5% a year. As a result, the annualized return during that period was at 16.2%, which is here, 3.5% higher than the S&P market, which is here. S&P return 12.7, Coca-Cola is 16.2. While buying Coca-Cola without worrying about the valuation would have generated a great return. But buying it at a lower valuation would have resulted in an amazing track record. Looking at a company's historical PE is another good way to look at the company's valuation, provided there is not much fluctuation in the interest rate during the same period. We can get this data from Bursa Marketplace under the research section over here. Now, this is the 5-year PE of Wittrox. Theoretically, when it trades near the 5-year average PE ratio, which is the dotted line over here, the valuation is reasonable. If there is no change in fundamental, note that even the valuation now and 2018 is almost at the same level, Wittrox earnings has doubled since 2018. 2018 is like 100 million here, now is 200 million. the stock price have moved in the same direction. In 2020, during the pandemic, there was a cut in interest rate. As a result, valuation for VTROX become expensive, which is the red arrow here, leading to a significant increase in its share price during that time. However, as central banks around the world began to hike interest rate in 2022, the valuation eventually reverted back to the average. While we may miss out on some opportunity by not buying a stock when its valuation is expensive, it can also prevent us from chasing after a hot stock with an insanely high valuation. This is Apex Healthcare. There was a slight increase in PE ratio since 2018, which is here. Coupled with an increase in earnings, the stock price has gone reasonably well over the years. The same goes for Apex Healthcare. Its valuation became expensive in 2020 and subsequently revert back to average, the red arrow here. So after we identify a high quality business, the next thing we need to do is try not to overpay for this business. Okay, okay, now last, a quick recap on our investing strategy. Firstly, we will focus on high quality businesses, the one with high return on capital, with opportunities to reinvest for growth, and with strong competitive advantage to protect their profitability. Next, we try to invest regularly so that we can take advantage when there is opportunity to own stocks when the valuation are reasonable or cheap. Lastly, we aim to diversify our portfolio by assembling a group of high-quality businesses from different sectors. This will help to limit our risk and ensure that our investments are not overly concentrated in a particular sector. Well, if you are interested in learning more about our investing strategy, please feel free to visit our page where we provide additional resources and insights for free. So my teammate will send the link over in the chat box. If you all want to subscribe for the WordPress, then you all can click on the WordPress and join our Facebook and Instagram page as well. Okay? And if you all have any question now, you all can type in the chat box. I had compiled... Can I continue?
Yes, sure, please.
Okay. Actually, we did compile few frequently asked questions from our client, and here's the one. The first question is, how can I determine which company are borrowing money to pay dividend if I don't know how to read financial statement? Now, we can use MSN Money, this webpage over here, a free website, to access the historical free cash flow per share for the company. By comparing this data with the dividend per share, we can easily determine if the company has a negative free cash flow every year while still paying dividend. You can look at here, the free cash flow, the arrow here, the free cash flow over here. If this is the case, it may be a red flag that something is not right. Okay? Now, second question is now a good time to invest? When is the best time to invest? Well, I think that buying when the stock market dropped 40 to 50% from its peak is ideal. These opportunities are rare, with only 4 to 5% incidence since 1900. Therefore, the second best time to invest is when you have the means to do so and when you have identified an investment opportunity. Like the strategy we mentioned just now, a diversified group of high quality business. When the valuation is reasonable, trying to time the market is difficult and can lead to missed opportunity or losses. The third question is, can dividend from stocks outpace inflation? If you are able to invest in a company that can grow its earnings at a rate that is higher than inflation, then yes. And what is the targeted amount needed to achieve financial freedom? And the target amount needed to achieve financial freedom really depends on our lifestyle and what you consider as financial freedom. If your idea of financial freedom is being able to travel in business class every month without worrying about the cost, then your target amount will certainly be higher than someone who prefer with traveling in economy class. In general, financial experts suggest aiming for a saving goal of 20 to 25 times your annual expenses to achieve financial freedom. For example, if your annual expenses are 50,000 ringgit, your target savings goal would be around 1.25 to 1.5 million. However, this is just a general guideline. At the end of the day, financial freedom means having enough money to do what you want, when you want, and how you want, without worrying about running out of cash. Another thing is, do I need to pay tax on shares? No. In Malaysia, dividend and capital gain on shares are not subject to tax. Okay, that's all for my side. And if y'all want to begin with share trading, let's open account with me. Okay, that's all on my side. Now pass back to Shane.
All right, thank you so much, Wai Ying, for doing this dividend investing topic for us. If you have any question to ask Wai Ying, please write them in the Q&A box. All right, the first question by Maslan is that can you explain why Maybank is not in your list?
One moment. I cannot see the question from the...
Yeah, so the question is, can you explain why Maybank is not in the list?
Oh, I need to open the Q&A there. Oh, okay. For banks, we prefer stocks with return on asset of more than 1%, and Maybank is not in the criteria. Does not fulfill the criteria.
Okay.
So far, only Public Bank and Hong Leong Bank fulfill this criteria.
Okay. But bear in mind, these are individual speakers criteria, huh? Okay, so just take
correct.
it as a reference. Okay,
correct.
It doesn't mean that what is any recommendation. Okay. The next question is by Bernard. You use some examples of the US market. How do you explain the Japanese market not performing for quite some time?
Japanese market, right? Japanese market was in a bubble in the 1980s. That's why it's not really that performing after the bubble and lead to a lost decade ever since then.
I think the Japanese market haven't been performing for 3 decades, I guess. So,
however, there are some stocks in the Japan perform quite well also lah.
So next question is by Andy Chi. Do full-time traders need to pay tax?
No need. Yes, you have.
Yep.
If your income is purely rely on the investment or investing or trading, then you have to pay tax.
So if investing is your primary source income, is your active income, then you have to pay tax.
Correct.
Okay, but if it is the source of passive income, like you gain from capital gain or dividend, then it is not subject to tax lah. That's what Wai Ying mean.
Yeah, correct.
All right. The next question is, why is there no sectorial ETF in Malaysia?
Sectorial ETF in Malaysia. Okay. Even the index in ETF is not active. So if we have launched the sectorial ETF in Malaysia, I guess the volume would not be attractive as well. And it's not viable for fund management company to launch a sectorial ETF.
All right. The next question is by Van. Can you compare the REIT valuation versus the MSG yield? Is it the right time to enter the REIT when the unit price has risen quite substantially?
REIT valuation against MSG yield. Right time to enter REIT when unit price has risen quite substantially. Okay. If the dividend yield is slightly higher than the 10-year yield, then it's still considered as it's still reasonable. However, it is not easy to get the data on the REIT index.
All right. Thanks, Wai Ying. So next question by Sebastiano. What criteria do you employ to select the stocks in your watch list?
Just now we mentioned already, with high growth and sustainable profitability and stability, and also with a good financial health, growing revenue and earnings.
Okay, thank you so much, Wai Ying. Okay, looks like we've addressed all questions.
Okay.
Okay, yes, one more. All right, last question. Apart from studying the fundamental for stock picking, do you consider technical analysis when it comes to buying stocks?
Fundamental playing as one of the main piece when it comes to select our company, but for technical, yes, as well, especially when the market is oversold, then we can try to buy more during that time.
All right, so thank you so much, Wai Ying, for doing this dividend investing for us. Hope that you guys have gained a lot of knowledge from this session by Wai Ying. So thank you so much, Wai Ying.
Okay, thank you so much, Shane,